fixed component, and then there's a variable component, a mixed cost. Now, let's get into examples of how we use the linear equation method and function to solve for mixed costs. Alright, so we have here in the middle, we have this chart, and it says month, and it goes January to December. We have number of sailing lessons, so this is a number, and then we have total sailing equipment costs. So this is not maintenance, but equipment. So yeah, like I said, you need life vests, you need boats, you need all the things that you need to have lessons. Well, those equipment costs, you need boats for one. So as the lessons increase, you'll see that those equipment costs increase. But you also even if you have no lessons, you still need to have that cost, right? So that's why this is a mixed cost, because you're going to need equipment regardless. But as the level of activity increases, so does that fixed cost, or that mixed cost, that level of equipment cost. So this is our given information. Now let's solve for the what the equation is using the linear equation method. So we take the high data point. So this is the high-low method. We take the high data point. The high data point is in August, summertime peak. So we say we had 4,800 lessons, and our total sailing costs, or sorry, our total equipment cost was 31,200. All right. Then we take our low point, which is January. Obviously, the wintertime is going to be our lowest point. So the low data point is 600 lessons, and then the cost there was 7,500. So to do the high-low method, the first thing we do is we solve for variable cost per unit. The equation up here for variable cost per unit is the difference in total cost, which is y, minus the difference in activity, x. So we take the y's, which is total cost, and the total cost was in August we had 31,200, minus the January 7,500, over the activity level, which is 4,800 lessons, minus 600 lessons. That gives us to a variable cost per unit of $5.64. Now, we take that variable cost, and remember, variable cost is equal to B in our equation, y equals A plus BX. So we put total fixed cost, remember the total fixed cost equals fixed cost plus variable cost per unit times activity level. Well, fixed cost equals, total fixed cost equals 31,200, which is y, right, in the equation, minus 4,800, which is x in our equation, times the $5.64, which is b, which we just solved for. Solve for that, that'll get us our total fixed cost equals $4,128. Now, so we put our fixed cost into our equation, and we get y equals $4,128 plus $5.64 x. So then this is the mixed cost linear equation for this set of data information. That's how you solve for that equation using the high-low method. Now we can use this data set and solve using a scatter graph and visual fit method. We're going to come up with a similar answer, but because we're guesstimating, or this is just an estimate, our answer is going to be slightly different. So what we do is we take a graph and we plot all these data points. So we got the 12 months, so we just plot all the data points, and then we draw a line that approximates the linear activity. So we plot all the data points, and then we draw a line, and then we estimate where this is entering the y-intercept. And from here, it looks like to me it's 4,100. It's the y-intercept. So let's do this. Let's solve the linear equation. Let's solve by doing a variable cost per unit at 4,100 was the y-intercept. So how do we do that? First, we take so we need to find an activity level. So we take one data point, and we're going to take January, and we're going to say at January total equipment cost was 7,500 minus our fixed cost, which we estimated to be 4,100, the y-intercept. That gives us 3,400. So variable cost per unit is the difference in total cost, which we just calculated, minus the difference in activity. Well, the difference in activity, because this is the y-intercept, our activity is 0, so whatever the activity was in January, that's going to be the difference, right? So we took the difference in the cost, and then we took the difference in the activity level, which is this point, because there's 0 activity at the y-intercept. Solve for that equation, and we get y equals 4,100 plus $5.67 x. So like I said, it's the same equation because we use the same data points, but because we guesstimated that y-intercept, it's slightly different. Okay, that's using the linear equation to solve for mixed cost. Yeah, basically that's it. It's the same algebraic linear equation that you saw in high school. Okay, we're on the back side of the Lesson 5 cheat sheet. Top right, we got the comparison of the contribution income statement with the traditional income statement. Under the traditional approach, we got sales less cost of goods sold equals gross margin, less operating expenses equals net income. Under the contribution approach, we got sales less variable expenses equals contribution margin, less fixed expenses equals net operating income. Okay, notice net operating income is the same, but the way we've grouped expenses is different. We got variable expenses, and then we got fixed expenses. And we've also got this thing called contribution margin. Alright, that's going to be important because going forward, we're going to want to prepare things on a contribution income statement approach so that we can break out the variable and the fixed expenses. That's going to help us solve for certain quantities that we're going to want to know. Alright, let's do a problem. Let's do the comparison of absorption and variable costing. So we got some given information. HMS Round Building Inc. makes 125,000 life vests per year. Variable manufacturing costs total $25 per vest. Variable cost per vest is $25. Variable selling and administrative expenses are $6 per vest. Variable $6 per vest. Variable selling and administrative. Fixed manufacturing overhead for the year. This is fixed manufacturing overhead for the year for the life vest factory is $375, and fixed selling and administrative expenses for the year are $200,000. During the year, 100,000 life vests were sold at a price of $70 per vest. There were no vests beginning inventory. Alright, no vests beginning inventory. That's good to know. Also, we can assume that some vests are going to be in ending inventory because we've made 125,000 and we only sold 100,000. Last part, management has prepared the table below summarizing the absorption versus variable costing information. Okay, so we've got some variable selling and administrative, and we've got some fixed selling and administrative. Under absorption and variable costing, if you remember from the other side of the lesson cheat sheet, variable selling and administrative and fixed selling and administrative are both treated as period cost and expense, not absorbed. Now, what's going to differ between the two is this fixed manufacturing overhead, because if you remember from the other side, that fixed manufacturing overhead is where they differ. Is under absorption, that fixed manufacturing is going to go as a product cost, so it's going to be attached to inventory. Under variable costing, it's not. It's going to be a period cost. It's going to be expense. So that's what we're going to need to know. That's what management has done here, is they prepared a comparison of those two where they've included fixed manufacturing cost in cost of goods sold and inventory under absorption, and they included it under a period expense under variable costing. Alright, so let's go to 1. Calculate the unit cost using the absorption and variable costing methods. The unit cost, right, of the absorption costing is going to be $25. Same with variable costing. This is $25. That's given up here. But our fixed manufacturing overhead we're going to apply to absorption costing, but we're not going to apply to variable costing. So you see, our total unit product cost is actually $28 for absorption, and it's only $25 for variable. Alright, let's go to 2. Prepare a contribution income statement using the absorption cost method. Okay, this will be easy, right? We've got sales. We know that's 100,000 times $75. That's the selling price. Less our beginning inventory, that was 0. We add our cost of goods manufactured, which is the 125,000 times $28. And then, so that gives us our goods available for sale, less our ending inventory, right? Because we have some costs still in inventory. That's our 25,000 times 28. So the difference between what's available for sale and what's in ending inventory is our cost of goods sold. The cost of goods sold, sorry, not our cost of goods sold, our variable expenses. It is our cost of goods sold. So we're going to take the sales less the cost of goods sold, and that's going to get us our gross margin. Now, that's the $4.7 million. Our gross margin, now we're going to subtract our selling and admin expense and our fixed costs. We're going to subtract the variable 100,000 times 6, because remember, it's $6 per unit for the variable selling, and our fixed selling and administrative is $200,000, and so that we have here is the $3.9 million. That's our net operating income under the absorption method. Number 3, prepare a contribution income statement using the variable costing method. All right, so what we've got here is we've got sales 100,000 times 75. It's the same, 7.5 million. We've got our beginning inventory, which is 0. We've got our cost of goods manufactured, which is 125,000 times 25, not 28, right? Because we're excluding those fixed manufacturing overhead costs. Then we've got our we've got our goods available for sale. That's 3.1 million, 3,125,000. So then we've got less our ending inventory, which is the 25,000 times 25. That's 625. So we got our variable cost of goods sold as 2.5 million. Then we add our variable selling and administrative expenses. That gets us to 4.4 contribution margin under the variable costing method. That 4.4 million, we're going to subtract our fixed expenses, manufacturing overhead, and selling and administrative expenses. It gets us to 575,000 on fixed. Our net operating income is 3.825, which is different from the net operating income under absorption of 3.9. So what are we going to now? Let's look at what happens in year 2, because obviously under the absorption, our net income is more because we've left some costs in the inventory, we've left some costs on the balance sheet. So in the second year, Round Belly again makes 125,000 vests, but sells 150. So we make 125, we sell 150. Probably we sold the 25 that were in ending inventory. Last year's 25,000 vests in ending inventory becomes this year's beginning inventory. The sales price is the same as last year, $75 per vest. Prepare a contribution income statement using the absorption costing method for year 2. So sales, 150,000 times 75, less cost of goods sold, which is going to be our beginning inventory, the 25,000 times 28. Our cost of goods manufactured, 125,000 times 28. Remember, there's nothing in ending inventory, so that 4.2 million is going to be our total cost of goods sold. Subtract 11.25 million from the 4.2 million. That gives us 7 million and then 50,000 as our gross margin. Now we're going to subtract our variable selling and administrative and our fixed selling and administrative. It gets us to 1.1 million, and we subtract the 7,050,000 from our 1.1. That gives us net operating income for year 2 of 5,950,000. Go to 5, prepare a contribution income statement using the variable costing method for year 2. Year 2, sales are the same. Our variable expenses are different though, because beginning inventory is 25,000 times $25, not 28, and our cost of goods manufactured for the period is 125 times 25, not 28. That gives us 3,750,000. No ending inventory, so we subtract that. That is now our variable cost of goods sold. Let's add other variable expenses, which is our variable selling and administrative expenses. That's going to be 900,000, which is the 150,000 times 6. That gets us to a total of variable expenses of 4,650,000. Subtract that from our revenues, and we get a total contribution margin of 6.6 million. Now let's subtract fixed costs. We subtract our fixed manufacturing overhead, and we subtract our selling and administrative expenses. That's the 575 for a total net operating income in year 2 of 6,025,000. Let's compare the two. When we compare the two, here at 6, it says, when we compare the two methods, note that the total income for both periods is the same. Total income for both periods is the same, but under the absorption costing, a portion of fixed costs are deferred to year 2 as they remained in the ending inventory, pushing operating income higher. In year 2, as those costs are recognized through cost of goods sold, net income is reduced. That's the difference between the two methods. So there's lesson 5. Thank you.